Hey everybody, Marty Missoura, the 24th of February 2016. Wasn't going to bug you again today, but today was so darn interesting that I thought I would share some information with you and explain or try to explain what went on today. Early this morning, I sent you an audio. Dow was down 200. Honestly, I did not expect the market to bounce back today at all. And my, did it ever. It was down 250 at one point, and the green line in front of you there on the screen is the Dow Jones Industrial Average. So there's the big decline, and there's the market just meandering its way ultimately to close a little bit in the positive. That can be explained by the mountain chart. That's crude oil, and when crude oil bottomed, we talked yesterday about the comments from the Saudis that really brought oil down a bunch. But it found a bottom here, and it began higher. In fact, it was interesting because the charts on oil, technicals actually didn't look too bad. In fact, there was some momentum indicators that suggested the price was really not consistent with what was going on in terms of oil futures trading underneath the surface. I'm not going to tell you I anticipated that, but technically speaking, it actually made some sense. Some production data out of the U.S., demand data actually seemed to quell some of the concerns over the comments out of Saudi Arabia yesterday. That surprises me. So it'll be interesting to see if oil can hold up. Clearly, it rescued the stock market today. I don't think there's any other explanation. The other thing that does come to mind is that the Flash Services Purchasing Managers Index came in today below 50. And that surprised me. That really surprised me. The services sector PMIs have been consistently and substantially above 50 for quite some time. Above 50 suggests expansion. Below 50 actually suggests contraction. So it'll be interesting to see when the final numbers come in. We're seeing conflicting economic data that actually says the service sector is doing pretty good, but I do take the PMI seriously. So there is maybe a chance that the market traded up because weaker economic data would keep the Fed presumably off the table in 2016. So it's a very fast-moving market, a lot of data coming in, and I'll do my best to keep you abreast on what I think is important. So let's get rid of that, and let's review the chart really quick. This is a chart I keep showing you. It's my 60-minute chart. I'm going to clean it up just a little bit more here. Okay, so hang on. Okay, so day before yesterday, I suggested to you that the fact that the market could not hold or could not penetrate that resistance right there was not a good technical sign. Plus, the market looked substantially overbought on a short-term basis. I said, look for a decline. We got it immediately. That was yesterday. We gapped lower. That was today. And then when oil bounced, we bounced really hard. In fact, the market was overbought. I'm sorry, oversold. If I said oversold, I meant to say overbought up here, oversold down here on a short-term basis. But I did not view that as a strong indicator. I really thought other technicals were going to see this market lower. So what a substantial and violent bounce to the upside. Filled that gap. When we dropped below it, it filled that other gap. And I told you these gaps tend to get filled like 90% of the time, which suggests we do have a leg lower to take care of that one down here. But we'll cross that bridge when we get to it. I did draw an arrow here. That's the August 26th low. Technically speaking, I would see that as potential support if we're going to hold above these levels that we first established back on January 20th. So suffice it to say, folks, market's going to be all over the place amid all the headwinds and tailwinds that are pushing and pulling it. Okay, so let me share with you just a little bit of my own research on commodities. And this is important because when you hear the doom and gloomers out there tell you that a recession is imminent, they love to cite the bear market in commodities. So having done what I do for a very long time, I have memory of times past, but with today's technology, we can actually go back and really see if our recollections serve us well, if our memory is accurate at all. So this chart over here on the left, this is the present day. So this is the Commodity Research Bureau CRB Commodity Index. It's a very broad index. It has everything from crude oil to lean hogs. And the biggest component happens to be crude oil. So here we are in June of 2014. I normalize this to 100 just for this comparison that you'll see here in a second. And from June of 2014, we are all the way down to 77. So a substantial 23% decline, got lower than that at the end of last year, has begun to bounce a little bit this year. If we go back exactly 30 years to 1984, we have a very similar looking chart. You can see normalized to 100, went from 100 coming back down to 79. So very similar from start, at least from start to finish, for the first year and 8 months of this bear market, if you will. So the question is, all right, so when this has happened historically, at least this one look, was it a indication that we're going to morph into some great recession? Well, if we just kind of add to this a year at a time, we can go to 1987. No recession. We can go to 1988. No recession, and commodities start to bounce. 1989. No recession. Commodities are really coming back, almost back to their peak of June of 84. 1990. Commodities came off a bit. People were probably saying, "Uh-oh, this could mean something." But then by the time, oops, didn't mean to do that. By the time we got to 1991, we're going to find our recession, but we also found commodities spike higher before we came into recession. Folks, if you've been listening and reading my stuff, you know that I've been maintaining that low commodity prices happen during recessions and help us get us out of recessions. High commodity prices are the things that contribute to the slowdowns, and it makes sense because we're pulling resources from other areas to pay for our energy and our materials and so forth. So this notion that a global bear market in commodities means recession, I don't think is really supported. In fact, the 80s we had what economists call a double cycle, where we came down and then came back and had several years of really good solid growth before the somewhat mild early 90s recession. So from the point which originally was roughly right here, we had about 5 years before recession. So I'm not making a recession call. I would be amazed if we go 5 years without the next recession, but I think this is interesting and somewhat telling. If we layer on the S&P 500 just to see how stocks did during the period, you can see on this historic chart that while commodities went down, stocks did fine. That actually makes a lot of sense to me, although we're seeing that pretty tight correlation lately between commodities and stocks this time around. But if we stretch that all the way out to that 1991 recession, we see that tough period in October 19th of 1987. I actually remember it well, which tells you how long I've been doing this. We had the worst one-day drop in history, but we actually came off of that and rebounded pretty nicely before we finally went into the next recession. Interesting thing about this recession is the market bottomed right near the beginning and came through it just fine. So if we take today and we just layer on the S&P, this is what it looks like. So during this patch here, we did see some weakness in stocks while commodities were falling. We're seeing that now, but there's nothing about today's chart, in my view, that suggests that we have a great looming bear market or the next great recession upon us. We may very well have that upon us or around the corner. The indicators, in my view, aren't giving us enough support to make that call. There are some stresses that I've illustrated for you here on the blog, and I'll continue to keep you up to date on and offer my opinion as things evolve. But right now, here's a good historic look that just what's happening right now by itself does not necessarily by any stretch mean that we have to batten down the hatches and prepare for the next great recession. Just want to bring you right back to where I started. There we go. Thank you, folks, as always, for watching and listening, and I'll talk to you again very soon. Take care.